Hello traders, welcome back to my YouTube channel. I hope you've all had a good weekend. In this video, I'm going to be breaking down a simple day trading strategy that I have been using for the past 3 years, which has enabled me to pass funded account challenges and also maintain them. One thing that I've noticed as my trading journey has progressed is that my strategy has got more and more simple, meaning that in this industry, keeping things simple is actually the best thing to do. Before we dive into today's video, make sure you hit that subscribe button so you don't miss any more content. I hope you enjoyed the video. Let's get straight into it. Okay, so the first thing that we're going to be doing is identifying the trend. So before I start, this chart that we're working on right now is the US dollar against the Japanese yen on the 30-minute time frame. So this strategy is a day trading strategy, so it works on the lower time frames, such as the 5-minute, the 15, the 30-minute, and you can also go up to the 1 hour as well, but I like to use the 30-minute for this one. The first thing we're going to be doing is identifying the trend, so identifying the high and low points within the market to determine whether the market is uptrending, downtrending, and seeing whether buyers or sellers are dominating the market. So we can clearly see that the market is uptrending. We're forming our higher low points followed by our higher high points. And we're just going to plug all of these points in to visually represent that the market is uptrending. And we do this just to kind of get that visual representation so that then later on we can identify when this has been broken, and you'll see that in a second. So we can identify that we're drawing our higher high and higher low points, and to visually represent that even further, we do like to draw on our trend line as well. Again, trend lines are very subjective. I'm not saying use trend lines in your trading. I'm saying use them to help determine your visual representation of your direction. So here we can basically see by connecting the high and low points, we can say that this is our low point here, like that. By connecting our high and our low points, we can see that the market is uptrending. We're trading within this ascending channel. So the next thing we're going to be doing is waiting for this trend, for this market structure to be broken. And when is market structure broken? So let me just visually represent this now by drawing this on. If the market is uptrending like so, and this is our most recent higher low within the market, market structure is broken once that higher low has been broken. So let's say the market moves up and then we get a move down like that. This level has been broken. So this is our confirmation that sellers have stepped into the market and have broken market structure. So that is what we would be looking for now. We're looking for this most recent higher low point to be broken. So we'll draw in our support level here, because that is the level that we need to see broken in order to start looking for our sell positions. Not only that, but we want to see it move to the downside impulsively. What we don't want is to see it do something like this, where it's struggling to break and it's moving slowly to the downside. This isn't a strong break. We don't want something like that. What we want to see happen is a strong, impulsive break to the downside in one big move like that. So we'll play it out and see what we get. Okay, so as you can see, we do get a nice impulsive move to the downside. That's a very, very strong one 30-minute candle, strong break into the downside, and we've broken out of structure. Now what we want to do is wait for our lower high to be formed. So again, I'll draw on down here. As we're uptrending, as an example, once that then gets broken to the downside, we're expecting to start to see structure like this form. So where's the optimal places to look for our sell positions? Well, it would be on the lower high formations on the downtrend. So that's what we're looking for now. We're looking for our higher low points within the market. So the way we're going to determine this is by combining many confluences. We want to know where is the most probable place for price to pull back to. So I'm going to take this back just a tiny bit more. So let's say to here. So where is the most probable place for price to pull back to? Because we don't really know. Could it pull back to here? Could it pull back to here? Could it pull all the way back up to this double top? Could it just pull back to where we are currently now and then move down? We need to understand where is the most probable place for price to pull back to, and that's where we combine our confluences. So the first thing we're going to draw on is our Fibonacci retracement tool. This is a tool that we use within our trading to help combine our confluences and find the most probable place for price to pull back to. So the way we draw our Fibonacci retracement is from swing high to swing low, like so. And now you can see the levels that we use. I'm going to click on this so you guys can see the levels that we use within our Fibonacci retracement. So these are levels we like to use: 0.618, 10, 0.5, and 0.786. Sometimes we like to use a 0.382, but in this instance we're not going to. And then if you want to see our coordinates and visibility, there you go. That is our style. And we'll scroll down a little bit there for you guys to see the rest. Cool, so that's our fib settings. So now what we're going to be doing is identifying, okay, well, which Fibonacci level do we want to see price pull back to? Which one is the most probable? Which one makes the most sense? And then we can determine where we're going to put our limit orders. So first one we're going to look at is the 50%. So this level here, we can kind of see it in there, but this is the 50%. Does it line up with any other confluences? Well, we have this most recent 2 levels of support. We can say that, yes. We've got support there and we've got our support there. So does that 50% line up with that support? Yes, it does a little bit. Could we see price come into that, use previous support as resistance and move to the downside? That is obviously a possibility. But is it the strongest place? Is it the most probable place for price to pull back to? Or is there somewhere stronger that we need to be careful of before considering that? And the next one we're going to look at is a 61.8, the one just above it. So we have the 61.8, but it also, as you can see, it lines up with this level of resistance within the market here. Now, why is this stronger? Well, all in all, the 61.8 level is stronger than the 50. It's known as the golden zone in the Fibonacci retracement. So not only is that a stronger fib level, but by this being a resistance, this is much stronger than a support being used as a resistance. Why? Because this is where sellers stepped into the market. Sellers didn't step into the market at this support level. Sellers stepped into the market here. That's where that downward move was generated from. So we know that there's sell orders at this level. So in my opinion, that level combined with the 61.8 Fibonacci is telling me that that is the strongest level. So I want to be getting in the market there. I know that's the most probable place. That's where I want to be getting in the market. So what we're going to do, we're going to set our limit order at that level. Now, next thing we're going to do, where are we going to put our stop loss? So our stop loss is going to be put in place in worst case scenarios. If price goes against us, we want to get out. And with this being said, we're going to use the next Fibonacci level. So in this case being the 78.6, we're going to use that as our level to put our stops above. So we'll trail our stop loss down, not right on it, a little bit of breathing room. Move this across. And that is going to be our level to get into the market, and that is going to be our stop loss. As you can see, safe above the 78.6. Now, where are we going to target? Where are we going to target? Well, first things first, we have this impulsive move. So we're going to use this impulsive move as our measurer for our targets, okay? So we're going to use the measuring tool, and we're going to measure from this swing high to our swing low to measure the distance. And then we want to use this as our distance for when we're in the trade to then get out. So down here is where we want to be getting out of this trade. So we can see that this is making for a nice 1:5 risk to reward ratio. Okay. So that is our target. Another thing to keep a note of is when we're selling, we want to see the market pull back in a certain way. So we have our impulsive move to the downside. We want to see a correction to the upside, like so, and then followed by another impulsive move. What we don't want to see is an impulsive move followed by an impulsive move. We don't want to be selling off an impulsive move. We want to be selling off of a correction. So we'll play price out and we will see what we get. Turn it down a little bit. Keep going. Okay. This is a very, very important part of the market. What do we see that has just taken place? We've seen candlestick formations at the 50% and previous support as resistance. We've seen evening star formations, candlestick patterns that will basically entice traders to get into this market. I'm going to delete this for now. Okay, what this is going to entice traders to do is to enter their sell positions. They will enter their market off of these bearish engulfing candles, and where will they put their stop loss? They will put their stops just above or even at the 61.8, like so, and then targeting levels down there. So this, for me, is a retail trap. This is a retail trap enticing traders to enter the market too early when they're ignoring that this level above here is the stronger level where the sell orders are. And this is just a trap for them to get stopped out, and then the market moves to the downside. How many times do you enter the market a bit too early and then you get stopped out and then the market moves to the downside? Like this, like you get stopped out and then the market moves. So your analysis was right, but you just couldn't quite get the entry. And that can sometimes be down to entering the market too early on a retail trap like so. We'll play the market out and see what happens. So remember, we have our position on here with our stops above the 78.6, and it was a 125, like so. Okay, we'll play price out. Okay, as you can see, we've moved up to the upside. We would have been tapped in. Nice movement to the upside. We've now tapped our level of resistance that we've had previously. Level of resistance has been used as resistance again. And as you can see, we get another nice impulsive move to the downside. Again, notice how this is like a correction within the market. I'm just going to delete some of this now to make it more clear for you guys. Notice how we've moved. This is almost like a big correction. And that's what we're waiting for. All that's doing is just building up liquidity. It's a resting period for these sellers. Impulse, correction, continuation. And we're out of the market. Now, a lot of people would probably target a lot lower, like down here, this support level. But in this strategy, we're just going to identify the most optimal take profit to use. Because if I continue price action, you can see that yes, we continue moving to the downside, like so. We do move to the downside. The thing we got to notice is we did see some correction at this level of our targets. As you can see, we found a support. So yes, sometimes the market will continue to the downside, and yes, the market might continue to the upside. It's just swings and roundabouts, but this is just a strategy that you have to stick with, and you'll be profitable in the long term. Discipline, consistency, stick with the same thing every single time, and you will be fine. So that's the first example. We're now going to show you a second example. Okay, so here we are on the second example. Going to be breaking it down the exact same way, just to help you guys to determine the steps on how to do it, basically. So first step, if you remember, we're going to identify the trend. So we're going to identify our high and low points within the market to determine the direction. And once again, this is clearly an uptrending market. So we're just going to draw on, you can say this is our first higher point. Okay, so we've identified that the market is definitely uptrending. We've identified the most recent high, most recent high low. We can visually represent that once again by drawing in trend line like so. We can say that the market is forming some kind of pennant within the market and connecting them. Okay, so we can connect that. We can see that the market is uptrending, but we can also see that the momentum is clearly also running out because we are forming this wedge pattern. You can say it's almost like a rising wedge within the market. So what needs to be broken now for us to determine to look for our sell positions? Well, we want our most recent higher low point to be broken. So we're going to draw in that level through there. And we're going to say that we want this to be broken before we start looking for sells. But what else needs to happen? How does it need to be broken? It needs to be broken impulsively. We need a strong impulsive move to the downside. That's going to help us determine. So we want to see that broken impulsively. So now let's see what happens. We'll play it out. Okay, so we've got a strong move to the downside now. Strong move, we've broken market structure. And now what we are waiting for is we're waiting for price. We're not waiting, sorry. We're going to now determine the most optimal place for price to pull back to. So what is the tool that we're going to draw on to help us to determine this? Well, we're going to draw on our Fibonacci retracement tool from swing high to our swing low here. And then we're going to look at our levels, look at the 50%, look at the 61.8, look at the 78.6, and see which level is the most likely, the most probable for price to pull back to. So I'll delete that. So first of all, the 50%. And once again, so the 50% lines up perfectly with our level in the market where it was our most recent higher low point. Again, so that support, again, like the last one we looked at, could that be used as a resistance? So that's our first level. Potentially, it's likely, but is it the most probable? Let's look at the next one. So the 61.8. Well, actually, let's look at the 78.6. The 78.6 basically lines up with nothing, in my opinion. There's nothing really there to determine. There's no resistance. There's no supports. There's nothing really to help us say that that level is a strong level where we can look for price to pull back to. But now we look at the 61.8 again, and it lines up with not only this level of resistance here, where we can see that price tried to move up and then we stepped into the market there, but also if we look over here with this level and this level, if we was to draw a zone through there, we can start to potentially determine a chart pattern. And what is this chart pattern that could potentially be forming? Well, it's a head and shoulders pattern. Now, head and shoulders pattern is a bearish reversal pattern. It shows us that price is shifting from bullish momentum to bearish momentum, bullish market structure to bearish market structure, I should say. So the 61.8 not only lines up with that resistance, but also lines up with this level through here. It's a strong level of resistance through here as well. So we've not only got that resistance, we've got that resistance and that resistance. So 3 levels that make it stronger. Whereas with the 50%, yes, it's the most recent high low, but it's just 1 point within the market. Whereas this level here is a strong resistance level where sellers have stepped in. So that being said, this is the level, the 61.8 is the level where we want to be stepping into our sell positions. And so once again, we'll put our sell limit there. And where are we going to put our stops? We're going to put our stops above the next fib level, above the 78.6, like so. And now where are we going to target? So we're going to use our price range to measure the distance of the first impulsive move we had, and then use that as our target for when we step into the market here. Like so. Now, why is this good to use? Well, if you can see that this level in the market down here also is potentially a good place to target. But as you can see, the tool that we used has told us to get out here. But why is that a good thing? So you don't really want to be always targeting the very bottom. You don't always want to be targeting the very bottom of the trend here, because as price approaches this level, what you'll tend to find is you'll tend to get wick rejections, you'll tend to get slight pullbacks, and you'll start to get kind of price just messing about. So you don't always want to target right down there. You want to target anyway just below. And once again, this is a nice 1 to 5 within the market. So again, this strategy provides very, very good risk to reward. So now we'll play our price and see once again what happens. Okay, so notice here how once again we found resistance. We found resistance at the 50% and we started to form a resistance, and people are potentially getting into the market here too early, putting their stops just above. And then what happens? They get stopped out and then the market moves in a direction. And this is the reason for that. This is what you need to be careful of in the market, is getting in the market too early when the market still needs to move to the upside. Fair enough if you can afford to take this loss and then you can just get into the market again, that's absolutely fine. But what most of you, and what I've been victim of in the past, is I'll get in the market too early, I'll then get stopped out, and then I'll just like leave the charts alone, and I'll come back and look at price, and price would have been, I would have got in price, and price would be in profit if I would just waited or I got in again. So either avoid it or just enter again at the better place where price is in. But we'll play out price and see what happens with our targets now. As you can see, price did move a lot further. Well, not a lot further, but it did break the support level, but that is not known. So I would rather be safe and use this tool to measure the distance and be safe and just get out of the market here, then be greedy and try and just target as much as possible. Be happy with the rewards, get out a nice 1 to 5, secure the profits off the table, and then just go with it. But yeah, guys, just to recap, so that is 2 breakdowns on this strategy. To recap, you identify the trend, identify the high and low points, visually then represent that by drawing in the 2 trend lines, support and resistance. What you want to see broken is the most recent higher low point within the market. You want to see it broken with a strong impulsive move to the downside. And then from there, as price is pulling back, you want to see it pull back correctively. You draw on your Fibonacci from swing high to swing low to determine the most probable place for price to pull back to. And then you'll set your sell limit, put in your stops in a safe place, and using the distance from the first impulsive move to determine the target for your position. Now remember, guys, this strategy is not invincible. It's going to lose sometimes. You're going to get some losing trades, but overall, with the positive risk to reward, with discipline and just sticking to your guns the whole time, you're going to take some losses along the way, but in the long term, this strategy should play out positive for you. So remember that, guys. But that is another example broken down for you. Remember, guys, no trading strategy is perfect, and there will be times when you will lose. For myself, this strategy has around a 40% win rate, which means I'm actually spending more time losing trades than I am winning. But thanks to a healthy risk to reward ratio, I'm actually able to be on top of the market in the long term. If you do want to take your trading to the next level, we do have our academy now available. Just head to the link in my bio on my Instagram, or just send me a message directly. You will not only learn everything you need to be profitable in the market, but you'll also have amazing opportunities such as trading capital at Vanquish allocation, or having the opportunity to come down and trade on our trading floor in London. Thanks for watching the video. Make sure to leave a like and comment letting me know your thoughts. But for now, I'll see you in the next video.